Welcome to Behind the Deal, where we'll be exploring unscripted, candid, first-hand experiences about the wild successes and cautionary tales of professional investors, founders, consultants, and advisors as they share their stories in deal making. Thank you for joining us for another episode of Behind the Deal. Today I'm joined by a friend and colleague, Jack Sadden. He is the co-founder and partner at Valesco Industries. Jack, thank you for joining us. Tell us a little bit about yourself and tell us about Valesco.
Well, thanks for having me here again. This is my second podcast with you, so looking forward to it. By way of background, I grew up in Pennsylvania. After 18 winters, I decided to seek higher education in warmer climates. Went to Florida State and went through their business school with a second degree in hotel restaurant administration, which led me to move to Dallas after joining Club Corp of America. And there I started out my career in operations, later moved into corporate development, and still later than that, spent a time as an advisor with Arthur Young and Company on buy-side advisory to what was essentially Russell 2000 companies. And still later, I found myself migrating towards private equity. By way of further background, I married my high school girlfriend. I have one daughter, no dogs, no cats, no fish. I played golf so terribly that my friends talked me out of it. So now I spend my weekends cooking meals as a closet restaurateur and enjoying wine. But you can't tell people you drink for a hobby, so I'll just say I'm a foodie at heart.
No, I can appreciate all of that. I think I may have forgotten that you spent some time in hospitality. I did as well, so we'll have to chat about that offline. But no, I can appreciate the wine enthusiasm. But we'll leave it at that, I think, for now. But no, again, thank you for joining for your second collaboration with me, and I'm really looking forward to this. You were kind of briefing me on this story when we spoke about this experience you had with an investor who had had a small investment and reaped a huge benefit, and then it went a little bit sideways. So tell me a story.
Sure. Well, the request you had of me was to share a fractured tale of caution. So I had to think about that for a while, and I reached back into vintage stories of deal days past. And this was at a time where I was still in advisory, working with buyers, largely originating deal flow for them, building strategies, and then finding candidates that fit the acquisition criteria. What's, I think, noteworthy about this is at the time that I got started, this would be what you and I would call the early days of LBOs.
Okay.
I think that's still a term that gets used, but maybe not. So let's call it the medieval period for lower middle market buyouts.
Yeah.
And at that time, the whole community was sort of black box. M&A knowledge was very limited. Acquisition opportunities or the sellers themselves were really inexperienced and naive about the process. Capital markets and the availability of funding for small business acquisitions was spotty and irregular and sometimes very difficult to find. And advisory services were very less sophisticated, much more scarce than they are today. But if you were industrious, if you were persistent, the opportunities as well as the chances for what I'll call significant acquisition value arbitrage was much, much higher. So this story deals with a situation that I originated on a very attractive company, and my client turned it down. But I had met what I'll call an aspiring client from my firm a guy whose ambitions far exceeded his resources. And today, I think, James, we would call him an independent sponsor. In those days, we referred to it as a fundless sponsor. But as I said, he was very, very ambitious and very eager to pick up on the company that I'd surfaced. And by way of background, the company was a Midwest aluminum mini mill. For those of the people listening in on this, they may not know what that means, but the company converted scrap into billets and other commodity extruded products. The business was also an orphaned subsidiary of a large publicly traded company that was under pressure to shed any unstrategic operations. So, with only a few limited competing bids for this business and this very eager seller to shed the business, my guy, the buyer, was able to negotiate a $33 million purchase of the business on a company that was doing $6 million of unadjusted EBITDA. The value came to slightly less than 5 times on an adjusted EBITDA basis. The
Quite a comeback.
buyer, which was at this point my client and his two partners, invested a total of $975,000. Now, that's on a $33 million acquisition. The rest of the capital stack was put together by proceeds borrowed from a non-bank credit subsidiary of a New York-based savings and loan, and that'll become significant in a little bit. At the end of the day, these guys were able to control about 67% of the equity for their roughly $1 million on a $33 million buy.
That's substantial.
Right?
That's quite a bit of leverage.
And now the good stuff starts.
Okay.
So the following things happened to us almost as soon as we got out of the blocks. Number one, due diligence was very crude at the time, and it was overlooked by both the seller as well as competing buyers that there was a $5 million LIFO reserve on the books of the seller or of the company. So right off the bat, we had a $5 million plus in our bank account. Number two, I mentioned that we set the acquisition up in conjunction with a New York-based savings and loan. That institution had a very significant net operating loss carry forward. At the time, there was a tax loophole that allowed this non-bank credit subsidiary to direct all the earnings from the company that it invested in through their income statement, and thus rendering all of our earnings in the early years tax-free. So we now have a turbocharged cash flow.
Wow.
Number three, in our first year, the company took delivery of a brand new continuous caster, which is the primary production equipment for a mini mill. We took delivery on a continuous caster that nearly doubled the capacity of the plant. And the good news on that was it was a capital expenditure that the seller had largely already paid for. So we were able to double our capacity with brand new efficient equipment on day one. But wait, it gets better.
Oh boy. Okay.
In our second meeting of the board of directors, James, the CFO comes forward with a proposal that he had presented to the former owners, but they decided to place it on hold. And the proposal was a hedging program. Now, at this particular time, hedging was still very nascent. In fact, I knew nothing about it. Neither did any of the other members of the board. The CFO explained how it was going to work to us, and essentially it was going to place our primary cost of goods and our primary revenue line items into a hedging program, and that program in our first year alone increased our earnings by $5 million. But
Wow.
wait, there's more.
Man,
There's
this is getting
more.
better and better.
Right?
Okay. The financial engineering is amazing right now, but yeah, what continue?
So in our first year, we witnessed a return of very active home building. The significance of this was it was the primary market for the company's extrusions. So when you take the expansion or the recovery of the market, that being the down market of construction, add with it everything I've already mentioned to you, and in our first 18 months, we increased EBITDA by a factor of 3. And revenues and earnings just continued to go from there. In the next 3 years, we were able to take the company public for a market value of 120 million. Remember, we bought it for 33, and we did that with $1 million of equity. They take it public for 120 million, and then a little over a year after that, we were approached by a third party who offered to acquire the business, rendering our 4-year run at a gain of $140 million. Now,
Wow.
I'm going to add to that even more. This was at a time where if you adjusted that to today's dollars, it would probably be about 2x that. So for about $1 million, we saw $140 million gain in real terms, but the equivalent today of a 280 win. So
Jeez.
there's the story. So it's a big wow, right?
Talk about hitting the lottery.
Grand slam, everybody's happy, laughing and scratching.
Yeah.
But if you stood back and you looked at what took place in real terms, it was an investment that was structured with odds that were really no better than roulette. And these guys just happened to get lucky with it. So now the epilogue, because the epilogue becomes the real story that I want to tell today. My original client, the guy who put together a couple of buddies and they all mustered up $1 million, his input in that was $325,000, and he walked away with $37 million, or what you and I would call about $75 million today.
Yeah.
That's a big payday. You should be
That's
really
massive.
happy with that.
Yeah.
But
Huge.
you should also recognize that every once in a while you get lucky in life.
Yeah.
But he went on from that experience and he continued investing with the mindset that he could duplicate that good fortune. So every time he stepped in the batter's box, he was swinging for the fence, and he swung at every pitch. And essentially, at the end of the day, James, he went about his business taking thoughtless risks, and he lost all of his earnings, all of his winnings off the original deal in less than 10 years. He ended
Wow.
up broke.
Wow. 70 million.
So,
Well, I guess the equivalent of $70 million in today's money, just gone in under a decade.
yeah, so what's the lesson here, or cautions to live by? Because this is what you really wanted me to chat about today. Um, I guess the takeaways are never confuse being good with good luck.
Hmm.
Luck, whether it's good or bad, is, in our estimation, at least 30% of every investment outcome
Is that right?
in private equity. Now, we do a lot of things to mitigate that, and we work hard to try and identify risks and threats and put things in place that either drive us to make a decision not to invest, or if we go forward knowing those risks, doing those things that give us a better outcome. Or said another way, hope is not a strategy, it's not even a tactic.
Yeah.
So, our thinking is that we should invest and execute with total awareness and purpose, and we look to achieve our successes by neutralizing risk, if you will. Um, so I guess the real bottom line there is taking chances is not the same thing as ignoring risks. Failure is always going to be a possibility, but you need to do things that keep you from making a habit of failure.
I agree. How do you? I'm curious how, for myself and for those watching, and just so we can kind of dissect this a little bit. How do you define luck versus being good? How can you tell which one it is?
So I'll answer it by saying how we approach. So it's really about identify what you can control and do everything that you can do to control it. And we measure everything in our shop, my partner especially. So I mentioned that we think at least a third of investment outcomes oftentimes are about luck. And by the way, it can be good or bad. I mean, I can have a perfectly good deal and have something like COVID come along and a pandemic that locks us all in our homes and have a business that relies on the world being able to go to events. And
Yep.
suddenly that business has zero revenues.
Yep. Which which actually happened to a lot of folks.
Right.
No, I know
And
some of
and so there's an example where luck comes along or bad luck comes along and ruins a perfectly fine company.
them.
The flip side of that, as in the story I just told you, it's one thing to take some risks, but when you lever a company 33 to 1, that to us is not being thoughtful. So how do we boil it down to what I'll call the takeaways? We believe that our controllables are about buying it right, running it right, and selling it right. So, what do we mean by buy it right? Well, invest in what you know, or at least what you understand and relate to. Secondly, balance your enterprise value with the risks and the prospects for success. Said another way, don't overpay. Know what your value is, know how far you're willing to stretch to buy a really good company, or conversely, know when to walk away.
Yeah.
Third, do your homework, investigate, exercise good due diligence, validate and verify. Do everything you can to make certain that you understand the business that you're going to put your capital into. And then lastly, structure the deal or the investment to set the stage for success. Every company has its optimum capital structure, that mix of debt and equity. How much senior, how much subordinated debt, how much equity. We have some investments where we provide virtually the entire capital structure, and maybe only will use an outside third party for a line of credit. So every business is going to have its own formula, and the key is to understand what that optimum structure is.
Yeah.
So run it right. Uh, to run it right, you have to be aligned, meaning shared vision with management. Everybody understands where are we, uh, what's our strength, what's our weakness, what's our threat, where are our risks, and start with a common view of what that is, as well as a common vision of what's possible. Now, notice I didn't say what's the future forecast. We start out getting to know a business by spending time with management, exploring what's possible together. And from there, then we try and lay out a business plan that's underwritten by a blueprint for moving forward. Then, second thing we do is we engage, which means we stay very, very informed and we stay very, very involved. Not doing day to day, but certainly being a partner to the business, bringing everything we can to contribute to the go forward strategy, but making certain that management has everything they need to succeed. Third, execution. This is about setting clear goals and controls and monitoring those things. If you get off course, then reset the goals and controls and the business plan to the new reality. And then lastly, having a sense of urgency. What do I mean by that? Manage the company like you're going to own it forever, but run it like you're going to sell it next year.
Yep.
Does that make sense? And do you appreciate the nuance there?
I do. I'm sure those watching will as well. I think that makes pretty good sense though to run it as if you're going to own it forever, but at the same time you want to run it like you're about to sell it. So
Yep.
keeping it in tip top shape
and being ready.
Yeah.
So lastly, selling it right. We believe that you have to have a plan to invest with the end game in mind. Where are you now? Where are you going? How are you going to get there? And how do you know what the destination is going to look like? What are going to be the markers for it? What are going to be the hurdles along the way that will indicate we're moving in the right direction at what speed and what time? Secondly, be prepared. As we just talked about, get ready to exit the day you invest and then run it like you're selling it next year, even though you might own it for 3, 5, 7, 10 years. Yeah. And then lastly, I got a question for you, James. What's the secret of good comedy?
Good comedy. Okay, yeah, right. That's perfect. Yeah, you're right. You're right.
So when you're going to sell it right, have a good sense of timing, and know when that's coming, and be able to take advantage of it. So before I hand the baton back to you, what's the moral of all this story I just shared with you for your audience? And I think it's just because you can doesn't mean you should.
I think that's gold. Honestly, I hope people watching will pick that up. I agree wholeheartedly. I actually had a little bit of a argument with an investment professional about that very notion not even a couple months ago. That was my take, was just because you can do it doesn't mean you should. And he completely argued against that, and I just thought that's a fool's errand. It's a fool's errand.
Well, let's put it this way. I've always felt like the other guy is going to luck out and be able to hit the cash window. But in my world, for me, I've never felt like that was going to be the way it would play out. Yeah. We've always done it with win by being as smart as you can and working as hard as you can.
Yes, I agree. And like you said earlier on, it's investing in things that you know or that you can relate to. I think that's absolutely paramount. Whether you're investing or you're marketing something, you should focus on the things that you're best at. Jack, I appreciate the story. I think the audience will as well. That's quite a tale for sure. And I love the insights. I think those are all noteworthy for sure. And I appreciate the story in your time for sure.
Okay. Well, yeah. We'll see you soon. And until we podcast again, take care.
Absolutely. And thank you guys for watching. And if you'd like to find out more about behind the deal and some of these stories, you can follow me on YouTube and find me on LinkedIn as well. Thank you for watching. Thank you, Jack.